Hey everyone, good morning, good afternoon, and good evening. Welcome back to the It's Attainable Real Estate Investing Show. It is episode number 6.
Welcome to the It's Attainable Real Estate Investing Show, where you will learn about investing, the power of real estate investing, and how to invest in it. Whether you have the time or even if you don't, you're going to see it's attainable either way. And now your host, who always wants to share knowledge with you, Christopher Balkin.
So in the last show, we talked about selling your real estate asset or investment. Why would you do that? As we discussed, it varies. We talked about what happens or the result of when you do sell your real estate asset or investment, and that's directly related to appreciation, which we also went in depth about. In this show, we're going to talk about another real estate income opportunity. We talked about cash flow in the past, which is an income stream for real estate investing. Selling your real estate asset is an income opportunity, and refinance income is yet another income opportunity as it relates to real estate investing. We're also going to talk about mortgage principal paydown, which is yet another income opportunity for real estate investing. We'll talk about depreciation and finally tax benefits. Refinance income. So what is that for those who are not familiar with it? So re in front of anything typically means to do it again. So in this case, refinance means to finance again. Now you can refinance quite a few things. You can refinance cars. Some might refinance credit card debt or other debts or loans. You may call that debt reconsolidation or debt consolidation. In this case, of course, we're going to talk about refinancing real estate. We're also going to break down refinance into two categories: rate and term refinance and cash out refinance. So rate and term refinance is exactly that, changing the rate or the term or the payment schedule of a previously agreed upon financial agreement. So you had a mortgage or you had a loan and it had an interest rate of A, and you decide you want to change that to B because B is available now and B is maybe less. You have a term of 5 years or 15 years or 25 or 30 years, and maybe you want to shorten that or lengthen it, and refinance allows you to do that. Rate and term refinance allows you to do exactly that. This is a perfect time to be thinking about refinance. I'm going to show you the math behind it, but this is the perfect time to be thinking about a refinance because, as you know, the economy is not in the best of conditions in terms of financially due to COVID-19 or coronavirus. Businesses have closed their doors, hopefully just temporarily, which has caused layoffs of employees, and unemployment rate is high. Because of that, the economy has just slowed to a halt. People aren't working, so people can't buy and spend, and that means that the businesses or companies close or they can't pay their bills and such. So all of that together just brings the economy kind of to a grinding halt somewhat. To aid in improving the economy or keeping it where it was before, the government, or at least the U.S. government, has tried to do lots of things to spur the economy, to get it back going or get it back to at least where it was before. One of those things is cutting the federal funds rate. This is a rate that has an impact on quite a few debt type of services. So it's like a benchmark of interest rates for credit cards, mortgages, different types of bank loans and such. So by making the interest rate potentially lower, the government sees this as an opportunity creating an opportunity for businesses and consumers to be able to have access to money or have access to dollars and capital at a lower interest rate. By creating that environment, their hope or their anticipation or their target is that businesses will continue to conduct their business, buy inventory or whatever the dollars in those businesses do. Business will still be able to get access to that loan or that lending of capital at a lower rate. And for the consumer, the hope or the target from the government is that the consumer will spend. If they make the interest rates on loans or give the opportunity for those rates to be lower than they have been before, then the consumer might be not reluctant to go ahead and pursue purchasing a car, maybe buying that new home or upsizing in this or that, or maybe spending on their credit card because the rate is a little bit lower. So you could do those things. You can go on a shopping spree because your credit card might be a little bit lower interest rate. You can buy a car, you can buy a house, or what you probably should do, what would be a good idea to do would be, if you own a home or you have a mortgage on the home, is to consider refinancing. So instead of going and spending the money with the lower interest rates on the debt side and the loan side and credit card side, take advantage of the lower interest rate on your mortgage, and then you can save money. So instead of spending, you got the opportunity to actually save money. Looking at the screen here, so looking at the math behind all this, what does a rate and term refinance do for you? What does it look like? So now that you know what an interest rate is, we know how that federal funds rate or that federal funds interest rate is a benchmark for credit cards, mortgages, and bank loans. The interest rate controls the amount of dollars in your payment that does not go towards what you purchased. So you've got your principal, which is whatever you were trying to purchase, the car or the item or the house, and the interest is the part of the payment or loan that does not go towards that. So that goes to the bank, or that goes to whoever holds the loan, and then a part of that payment goes to whatever it was you were trying to purchase. So by lowering the interest rate, you have the capability of lowering your payment, or continue to make the same payment as you were making before and allow more of that payment to go toward the principal or the actual thing you were purchasing. Again, the house, the car, the item, whatever it might be in the loan. If you look at a rate and term refinance, and look at the top part of the screen here, this is just an example of what a refinance can do. So if you purchased a home or a real estate asset for $435,000, the loan amount after about a 20% down payment or so would be $352,739. Interest rate of 5.67% when we purchased it, that's a monthly payment of about $2,219.57, $2,219.57. After 5 years of paying the payment, 60 months, the balance after 5 years would be $316,747, approximately. So let's say you want to now do a refinance because the interest rates are lower, like they are today, than they were when you purchased the home before. So before the interest rate was 5.67%, now the interest rate is, for example, 4.5%. The monthly payment is now $1,772.16. That's a drop of $447.41 from what the payment was before. Now that's partly because the balance of the loan, of the refinance loan, is going to be less, and it's also partly because of the interest rate. So that $447, that's a significant amount of dollars monthly that you can do whatever you like with. Ideally, if you were comfortable with the $2,219 payment, you can take that $447 savings and continue to make the same payment, paying off your home or your real estate asset at a faster pace. Or you can take the $447 a month and go on a shopping spree. Well, I wouldn't recommend that, but I guess it doesn't hurt to splurge a little bit. Okay, so let's look at another refinance opportunity. This one's going to just show you the difference of what approximately 1% of interest can do. So this is going to be the same loan, just with a different interest rate. Just want to show you what the power of interest can do to help you. So purchase price, again, $435,000, same about 20% down payment, leaving a loan amount of $352,739. So interest rate 5.67 gives you a $2,219 payment. Interest rate of 4.5% in the lower section of the screen here gives you a monthly payment of $1,973. That's a savings of $245 difference just in the interest rate. Nothing changed. You had the opportunity to purchase the same assets, same mortgage, same home for the same price, same amount of down payment. It's just the interest rate's different. So please do take advantage of the interest rate being lower. If you're, as of this writing, this is April 2020, if your interest rate is above 4%, maybe above 4.5%, I strongly recommend that you contact your lender who already has your mortgage, maybe shop around with some other mortgage lenders, and just see what the opportunity is for you to have a lower interest rate. It can be a significant amount of money that you can save per month, or if you don't need the savings, it's a significant amount of money that you can put back into your home and pay off the home sooner. So the rate and term refinance allows you to change the term or the rate or the length and different aspects of the loan. It doesn't allow you to change the amount because the amount of the purchase is what it was, but the rate, the term, the length, different aspects of the loan. So you typically, or you usually would do a rate and term refinance if you have the opportunity to get a lower interest rate. It doesn't always mean the economy being down or in a downturn requires the interest rate to be lower. Perhaps when you initially purchased the home or the real estate asset, your credit score was lower. And 4 or 5 years later, your credit score is higher. You may qualify for a lower interest rate with the bank because of that. So there's different things that could cause you to be able to save money, to be able to lower the interest rate like I've shown here. So make the call. Call the lender who has the mortgage for your home and at least do that. At least save yourself some money. You can thank yourself. You'll thank yourself later. Or if you have real estate assets, do the same thing. Call the lender who holds or services the mortgage in those real estate assets and see if you have an opportunity to save. Again, save the money and do something else with it, or put the money right back into the real estate asset or your home and pay it off sooner. So I said there was 2 categories we were going to break refinancing into. The first is rate and term, and the second is cash out refinancing. For cash out refinancing, we're going to go and look at the second example we had from before, the balance after 5 years. And we're going to bring in our handy calculator here to take a look at this as well. So as payments are made each month on your real estate asset or your home, for example, part of the payment goes toward interest, as we discussed with the interest rate, and part of it goes toward the principal. As the principal payments continue to get made each month, the balance left over continues to decrease and decrease each month. The difference between the value of the property and the balance left over on the principal of the mortgage is known as equity. So a cash out refinance allows you to take advantage of that equity. Previously, when we sold the property in the last show, or when we sold the real estate asset or an investment in the last show, we recouped whatever the value of the property was at that time. So ideally, we recouped what we paid for it, and maybe a little bit more with appreciation, or maybe a lot more with appreciation. But a cash out refinance allows you to get access to that capital or those dollars that were put into the purchase price of your home or your real estate asset or investment without having to sell it. Now that is amazing. So let me restate that in case I confused you and it wasn't clear. So when we sold our real estate asset in the last show, or the real estate investment was sold in the last show, the return stopped. Any monthly rents and income we received, that stopped. That went on to the next person who purchased it from us. However, in selling it, we would have received what we purchased the asset for ideally, and maybe we would have received more than what we purchased it for in the case that the value of the real estate went up in price over the years and we were able to sell it more than what it was when we purchased it. So in order to do that, we had to sell it. We had to get rid of it. It's like selling a stock. Once you sell the stock, it's gone. All the returns stop. Hopefully you sold it for more than what it was when you purchased it. That's a great thing. Refinancing in real estate, which by the way is not available with stocks, refinancing in real estate allows you to get access to the capital or the dollars that are in the real estate and still own it. So you continue to still get the cash flow each month from the income from the rent and lease payments that come in, but you also get access to the capital or some of the capital in the real estate asset. Now, what makes that amazing? Well, it's amazing because ideally you would do something smart with the capital that comes out from the refinance, from the cash out refinance, something smart like invest in something else. Like put that those dollars that come out from the refinance into another real estate asset. That's what makes it amazing. You take the returns from your investment and you reinvest them into the next investment, and so on and so on and so on. But first, let's take a look at how this works. So as we use our handy calculator here, we know that we made a purchase of $435,000 on this real estate asset. We put approximately 20% down, left a balance of $352,739. We made 5 years of principal and interest payments, and at the end of 5 years or 60 months, the balance left over was $316,747. Now, a bank will typically let you take 70 to 80% of the value of a property as a cash out refinance. Now, I only mention your personal residence if you own a home or have a mortgage on one. And this is a real estate investing show, but I only mention your personal residence or home because I want to stress the opportunity here that you have here in April 2020 to look at doing a refinance on your personal residence and being able to lower that interest rate potentially, and then likely saving yourself money each month, potentially if the interest rates lower for you on the refinance. But anyhow, if you do a cash out refinance on your personal residence, instead of 70, 75, 80% cash out refinance, a bank may give you 90 to 95. It'll depend on the bank, but the bank considers that a little bit less risky. Now, we learned in episode or show 2 or 3 that banks like real estate. It's a tangible, secured asset. If something happens, you don't make the mortgage payments, they can come and get the asset or the real estate, and it's always going to be worth something to them. They don't want to do that. They're not in the real estate business. They're in the banking business. But if they do come and get the real estate asset or the mortgage because you didn't make the mortgage payments, it's going to be worth something. Now, your personal residence is less riskier to the bank because they know that if times get hard for some reason, you can't make mortgage payments or something goes wrong, you're usually going to take care of home first. You're going to take care of where you live first. And if you think about it, that's probably true. You're going to take care of the roof over your head maybe before you take care of other investments and things that you might have going on. So the banks, whether it's right or wrong for everyone or not, the banks typically consider that less risky. So they will allow you to take 90% cash out refinance, or 90% loan to value as it's called, from your home. So what does that mean? What does that look like? So let's use our calculator here, and let's use that value of $435,000. So again, we purchased a real estate asset for $435,000. 5 years later, it's probably going to be worth, or should be worth, more than $435,000 just due to natural appreciation like we talked about in the last show. But just for this example, let's just say that it was not. Everything remained the same. 5 years later, it was worth the exact same amount. So we're going to do $435,000 times, we're going to say 80% loan to value. So times 80%, or 0.80 in a calculator. That means that the loan to value at 80% is $348,000. So $348,000 is 80% of $435,000, in saying it a different way. So that's 80% loan to value. Now, there's still a balance on the real estate asset or your home. That balance is $316,747. So let's go ahead and subtract that. So you're left with $31,253. So $31,253 is what's available for you as a cash out refinance. So that gives you the ability to take that cash and do something else with it. Ideally, go and invest in something else or put that toward another investment. Maybe it's enough to acquire a whole nother asset altogether, depending on the price. Or put that with additional dollars or into an investment of someone else's. If you're going to be passively investing, take that capital and put it into an investment where there's other investors, and together a larger real estate asset can be purchased if you're going to invest passively in that way. Whatever you do, you want to put this into something income producing. So take this $31,253. You don't want to go and create more debt for yourself. So take this capital and go and put that into something else income producing, because this $31,253, this is going to go back onto the balance. So the balance is going to be $316,747 plus the $31,253 that you took out. So go and do something productive with that. Don't go and double the debt. Don't go and spend it on something that's not useful. Oftentimes, people will, or the banks will advertise using this to improve your home, because maybe you can do something to your home that makes it more comfortable for you to live in, or do something to your home that makes it more valuable. So instead of $435,000, maybe you put this $31,000 into your home or into your real estate asset and make it worth $450,000 or $460,000. That is the smart thing. That's the recommended thing to do, is ideally to put this back into your home or to do something that brings income. So if you take this $31,253 and put it into something that then pays you back, like real estate investing does, that would be the smart and the recommended thing to do. So that's the power of cash out refinancing used in a good way. In the last show we talked about, or the prior show we talked about good debt and bad debt. You can see we added debt. In this case, we're adding this $31,000 back onto our balance, but it's good debt if you do something good with it. So what are you going to do with your savings? If you own a home or have a mortgage on your home and you make the call to your lender or another lender, and you either do a rate and term refinance and you have extra money left over each month, or you do a cash out refinance and you have a lump sum of money, a check written to you, what are you going to do with your money? I want to hear from you. Send me some comments. Wherever you're listening to this show at, you should see an option to ask a question or leave a comment. Let me know what you're going to do. I'm curious. I want to hear from you. And if you want to put it into real estate, by now, after listening to these shows, you know that's a good place to put it. So let me know. I can put it to work in a real estate investment for you. Okay, moving on. So I talked about when a mortgage payment is made each month, part of the payment goes to the interest. The interest goes to the bank or whomever holds the mortgage. And the other part of the payment goes toward the principal. And the principal is whatever the mortgage was for, typically a real estate asset, or as we compared it to your home. Now, as the mortgage payments continue to get made each month, the balance of the mortgage, or the balance of the principal, reduces each month. Now, on your personal residence, if you own your home or have a mortgage on your home, you make the payments each month. From your job or career or retirement or wherever your income comes from, if you have a mortgage, you make the payment from that income each month. With real estate assets and investments, the tenants make the payment each month. So your home, when we talk about assets, I keep saying real estate is an asset, and I haven't used the term liability a lot, but liability would be anything where it's costing you money each month. So your home would be considered a liability. That's not a bad thing. Maybe having too many liabilities could be bad or determined bad, but you need somewhere to stay. Wherever you live, it's probably going to cost something. So your home would be considered a liability, but you need a place to stay, and it costs to live in a place, that is, until it's paid off if you are buying it. Now, real estate is considered an asset, and I keep saying real estate asset or investment because it puts money into your pocket. It provides you an income stream, as you have seen through the shows so far. In fact, it provides you multiple income opportunities. The first is cash flow, the income from tenants. Those tenants could be in a home or apartment building. Those tenants could be individuals or families. If your real estate asset is a building, like a store or retail storefront, those tenants could be stores or retailers or restaurants that you yourself visit or see each day. If your real estate asset is an industrial park or an industrial type of building, your tenant could be a factory or a company that runs the factory. In all these ways, it's still a tenant versus owner or investor relationship. So with the real estate asset, the income from the asset from the tenants pays your mortgage each month. So every month, the payment that gets made comes from the income from the tenants. So the mortgage, as it gets paid each month, the balance goes down and down and down. It's a downward trend. Now, in the last show, we talked about appreciation, and appreciation is an upward trend of real estate. So I want to show you something. Let's take a look at this chart. And in this chart, you're going to see the mortgage balance going down and the real estate asset going up. If you're watching this and you have a sheet of paper next to you, I want you to draw a V. And if you're in your car or you're traveling, you don't have a sheet of paper you can write on, let's draw an imaginary V in the air. And on the left side of that V, that is your real estate asset value, and it's going to the left. And on the right side of that V is your mortgage balance, and it's going to the right. And in the middle, as the V gets wider and wider, it's infinite, right? As the V gets wider and wider, everything in the middle becomes equity. And I spoke about that a few moments ago, that the difference between the value of your real estate asset and the mortgage balance is equity. That also can be known as your net worth. If you're investing in this real estate asset, or you're investing in real estate, the difference between these two, or the difference between liabilities and assets, is net worth. You may see this on TV, where the net worth of individuals such as celebrities and such are mentioned. Well, we all have a net worth. It's just the difference between your liabilities and assets. And all those things can be the same, whether a celebrity, whether or not. The assets could be things like cash in the bank, cash in the savings account. It could be investments in your investment portfolios and stocks. The assets could be real estate, like we've talked about here, and frequently it is. The liabilities would be things like credit card balances, loans on cars, loans or mortgages on real estate, and any other type of debts that someone might have, whether a celebrity or whether not. The difference between the liability and the asset is net worth. So with real estate, we just talked about how the tenants pay your mortgage each month. And those tenants are, again, whether individuals or families or companies or stores or restaurants, etc. Those tenants pay your balance each month. So those tenants are increasing your equity, and they're increasing your net worth each month. So you tell me, where else in the world does this happen? I'm not saying it doesn't happen anywhere in any other type of investments, but you tell me where it's tangible, it's something real, it's real estate, it's a structure, where the business or the real estate investment or the real estate asset increases your net worth in multiple ways each month or each quarter or each year. So you have cash flow, that's the difference between your income and expenses. What's left over goes to you or the investor. That is income, reoccurring income each month, quarter, year. You have the real estate asset that will typically increase in value, and that's known as appreciation. We know that can come natural, or you can force it, as we talked about in the last show. And then we have mortgage principal pay down, which I call that another income opportunity for real estate, because as that mortgage principal gets paid down, that balance goes down, the part in the middle, that equity goes up. And as we just finished talking about, you can use that equity. That equity is accessible via a cash out refinance. As we look at this chart, let's look at year 1 and year 2, 3, 4, and 5. Year 1, the equity was $152,220. The difference between the value of this particular real estate asset and the mortgage. We'll skip to year 3, $186,000. And in year 5, $223,516 is the equity that's in this real estate asset. And what did you do? Depending on if you were the active investor and you were doing things to force the appreciation, or you were managing the contractors who may be maintaining the building, or you were managing the property management company who's taking care of the real estate asset, or maybe you were a passive investor and you didn't do anything. You just invested your money just like you would in a stock or any other investment, and you just received a check each month. And this equity can be taken out and given back to the investor, the passive investor, to proceed with another investment or whatever the goals of that investor or yourself might be. If we bring back in our calculator and just do the same math we did before to see how much equity can be used, how much equity the bank or the mortgage holder might give us, if we take the value, simple formula here, we'll take the value of the real estate asset here in year 5, and we'll multiply that by the loan to value, we'll say 75%. So $409,938 is 75% of the real estate asset. And we'll go ahead and subtract the balance of what's left over on the loan or on the mortgage. So $86,870 is available in equity that can be used for something else, either return to the investor so that you yourself can go and do something else with it, potentially invest in another real estate asset, or whatever your goals were for the income you could potentially receive from this investment. So are you ready to increase your net worth, bring financial stability to yourself or to your family, or create generational wealth for your family for years to come, or whatever your individual goals might be? You got to get started. You got to start somewhere. It's never too late, but it gets a little bit harder each day you wait. Okay, I'm going to close this show and we'll get ready for the next one. But hopefully you found it beneficial. And if you did, share the knowledge with someone else. As I share with you, share the show and the knowledge with someone else. Sometimes you might find it's easier to go on this journey not alone. So take the journey with someone else. We learned today about refinancing and refinance income. It's action you can take right now, even if you don't have any real estate investments or assets today. If you own a home or you have a mortgage on your home, refinancing can be a large impact today. It can help you today. So don't forget about that. We talked about mortgage principal pay down and how powerful that is, increasing the equity in your real estate investment. We're going to get to depreciation. We're going to talk about that with tax benefits. It's funny, over the years I hear these cliches like the tax man cometh and the tax man being Uncle Sam. We're going to talk about the tax benefits of real estate investing and how you'll pay your fair share, but not anything beyond that. And you'll be surprised. Your fair share might be a whole lot less than you think. All right, one more thing. So I need your feedback. I need your comments. Let me know what you think about the show. Share your questions, share your comments. Let me know if you're getting this, if it's helpful, if you got questions, if there's some specific topics you want to talk about. So reach out. Let me hear your comments. Let me hear your questions. And I'll see you next time.
You have been listening to the It's Attainable Real Estate Investing Show, sharing transparent knowledge on investing and the powerful impact real estate investing can have on your wealth and lifestyle. Follow or subscribe to the show using your favorite podcast app so you'll know firsthand when a new show is released, or visit neelyrealty.com/podcast and see the show there. That's NILEE realty.com/podcast.